The idea of a massive 660-ton silver dump by China immediately captures attention. It suggests a sudden large-scale shift in commodity markets. To understand this, we must examine the mechanisms, motivations, and implications driving a nation to release such a significant volume of silver. Global markets interpret and react to such events. Commodity markets are complex systems. Large transactions rarely occur in isolation. They are often part of broader, strategic, economic, or policy-driven decisions. Silver holds a unique position as both a precious metal and industrial input. Its price is influenced by investment demand, industrial consumption, currency movements, and geopolitical factors. China's influence raises questions. One key aspect is whether dump accurately reflects what is happening. Often, it's a coordinated release of inventory. This could be through futures markets, exchange deliveries, or state-linked entities adjusting positions, not a literal one-time sale. This distinction is important. It affects how the market absorbs supply and how prices respond. A gradual release differs from a sudden surge. To understand this further, we look at major trading hubs like Shanghai. The Shanghai Futures Exchange is central to price discovery. Activity there influences regional sentiment and global benchmarks, especially when trading volumes spike or position shift. If significant silver enters the market through these channels, it can create downward pressure on prices, especially with weak demand. It's also important to consider the broader economic context. China's approach to commodities links to its industrial strategy. This includes currency management and macroeconomic objectives. If manufacturing slows, China might reduce holdings. This stabilizes domestic markets, manages costs, or reallocates resources. Alternatively, it could be a broader financial strategy, aimed at influencing global prices, hedging against currency fluctuations, or responding to trade dynamics. Why a reversal after accumulation? Countries build positions based on future demand or price appreciation. If expectations change, they unwind positions, increasing supply. Leverage trading complicates this. Positions in futures or derivatives adjust quickly to price movements, amplifying the dump. Global demand is another key factor. The impact of a large supply release depends on the market's ability to absorb it. If demand from other regions, like Europe or North America, remains strong, it may offset additional supply. However, if demand is weak, the same volume could lead to a more pronounced price drop. This highlights interconnected global markets. Currency movements also play a crucial role. Silver is typically priced in US dollars, so exchange rate fluctuations matter. A strengthening US dollar during a large silver sale could amplify downward pressure. A weaker dollar might cushion the impact. Beyond fundamentals, market psychology and perception are equally important. The narrative itself influences trader behavior. This leads to increased volatility as participants react to supply and expectations of further selling or policy changes. This creates a feedback loop where initial price declines trigger additional selling, reinforcing bearish sentiment. However, such events can create opportunities for long-term investors who view lower prices as an entry point, or for traders who anticipate and respond to short-term volatility. This dual nature of risk and opportunity defines commodity markets. Large moves create both winners and losers depending on timing, strategy, and risk management. It's a complex dance. Ultimately, the China 660-ton silver dump reminds us of the scale and complexity of global markets. Large players influence prices, but their actions are shaped by economic, political, and strategic factors. Understanding these dynamics requires analyzing the immediate event and a broader perspective on how commodities are traded, how policies are formed, and how markets respond to changes in supply, demand, and sentiment. By examining these elements, traders and investors move beyond sensational headlines to a more informed view. Navigating the market with greater confidence and awareness, no single event exists in isolation. Every major move is part of a larger narrative that continues to evolve over time in the global silver market.